This is a warning to all new UK investors. This is especially important if you're somebody who's looking to make money from the stock market. Pay very close attention, because without knowing this special piece of information, I should say really urgent information, then there's a very high likelihood that your hard-earned capital is going to underperform. So hi, my name is Jay Campbell and welcome to Maximise Your Money. Quick disclaimer, I'm not a financial advisor and nothing in this video is financial advice. Everything in this video is purely for entertainment and educational purposes. So with that being said, let's get straight into it. And there's a very key point that I really want to make very known here, and that is actually the stock market does not always go up. So what do I mean by that? We're going to look specifically at a few instances where in the history, the stock market has actually not performed very well over the period of more than a decade. And this is really important for this time in particular, because if you're a new UK investor or a new investor in any global market, you will have seen over the last year that prices of stocks and funds have been doing extremely well, but this is not always the case. And I want to just show you by looking at the charts exactly what I mean by this. So let's get right into it. And by the way, if you're new here, then go ahead, make sure to subscribe, like the video if you gain something really valuable from it, and stay around to see new content from investing in stocks and crypto from a UK perspective. So we're going to be looking at the S&P 500 right here. The S&P 500 is essentially the largest 500 companies in America. It's one of the most popular stock funds available in the world. Even Warren Buffett himself, in a letter to his shareholders, had said that actually to average investors, he recommends that they invest about 90% of their money into stocks in the S&P 500, so the S&P 500, and then 10% in bonds. So obviously, with the S&P 500 being so popular, it's a great place to just understand exactly what I mean. If you have the thoughts that this is a actual easy way to make money just by putting your money into the stock market and just seeing it go up, then you have to see this. So if you would have invested in March of 2000, the S&P 500 was at 1,464. 10 years later, it still hadn't recovered to that position. As you can see here, no real differences at all. Like, there's been extreme dip here, and then it slowly goes back up and it goes down. And actually, it would have taken up to around 13 years later for you to have seen the return on the investment. And then, of course, from there, it was happy days. It's been extremely bullish. But just having a look at that, how many people would have had the nerve to sit through a time period of 13 years in order to get a return on their investment? Looking at this data, it gives us a really good idea of actually the reality of what can happen in the stock market. We've got to know that just by nature, the stock markets are uncertain. Nobody knows what's going to happen. And it's really important to be able to understand actually from the data of the markets how investments can play out over time. Because if you were somebody that was putting your money into the markets at that time with a thought of guaranteed returns, then maybe you would not have seen any returns. If you had 10 years later decided this isn't working, I am out, and actually you would have missed out on some of the greatest gains that we would have seen in our lifetime of investors. So that is just a really key point to actually mention there. And also, the same case we see for the FTSE 100 as well. It's not an isolated incident. Actually, another scenario here is if you would invest again in about March of 2000 in the UK market, then it would have taken, actually looking at the data here, even to this day, you would have not have made a profit if you didn't take anything off the table, because the price since 2000 is actually higher than it is today. So in 21 years, the FTSE 100 is now still under, and you would have had negative returns. Key point to know, the stock market does not always go up. So, of course, if this is true, guys, like, what do we do about this? I know it's a pretty difficult message to kind of see, but there are actually some good news, because there are ways around actually this scenario of a worst case incident of seeing our investments do really poorly, as you've seen here. The first one of those is to diversify, not just within stocks, for example. That is, of course, a good idea, maybe to select different funds across different global areas. And I've got a video up here about why diversifying globally is potentially a really good idea. But diversifying across different asset classes. What do I mean by that? Actually, when it comes to investing, it's not just stocks that you have. You've got stocks, you've got bonds, you've got real estate, cryptocurrencies, gold. I myself personally am an investor in gold, cryptocurrencies, stock funds. I hold cash as well. And all of these things actually allow me to diversify the risk that I have. I've been reading a great book called The Permanent Portfolio, and that just talks about actually the ability to diversify into different areas of assets so that if one asset performs really badly, like the stock market over an extended period of time, you've got other assets that can take its place and do really well. So overall, you're up during those times where people that had only concentrated, for example, on just stock funds may have been down if they didn't diversify. So really key concept is diversification, not just within the fund market, but also within different asset classes as well. So here's what I'm going to do with this knowledge personally. For myself, of course, I'm only investing what I'm willing to lose. That's always the key point, so I can actually sleep well at night. I'm diversifying across different sectors, like, as I mentioned, stocks, crypto, gold, and of course, real estate coming up is one of the ones I'm really excited about. In the meantime, I'm focusing on maximizing my income so I can have more to invest into all of these different assets. And most importantly, I'm educating myself as much as possible to actually understand how the markets perform. And of course, we all work really hard for our money. So the last thing that we want is to go into an investment without knowing what we're actually doing. So of course, educating yourself as much as possible is always a really, really good way to stay ahead of what's going on in the marketplace. For example, if you're new to the world of investing, maybe you've heard about cryptocurrencies and have no idea what they're all about. I've got a video in here that talks all about how to learn cryptocurrencies, for example. So I recommend that you check that out if you've been interested in seeing what Bitcoin or Ethereum's about. But actually, from my side of things, guys, that's all I have for you today. Hope that was a nice quick video that got really to the point of something that you should be aware about before investing. Always do your research before you do invest in anything, so you've got a good idea of what you're doing, and seek financial advice if that is something that you think is appropriate for yourself. So with that being said, if you've loved the video, go ahead, hit the subscribe button to support the channel so you can see more videos like this in the future if you haven't subscribed already, and also give the video a like if you really enjoyed it so other people can find this valuable content as well. And with that being said, I've got 2 videos on the screen that show you more videos about the stock market, cryptocurrency from a UK perspective. Go ahead, check those out, and I'll see you in the next one. Take care, guys.